Here is a trap. The market springs over and over, price pokes just above a level, triggers a flood of stop losses, and then reverses, leaving those traders behind. That is a liquidity sweep. In the next few minutes, you will get the complete 5-step plan to trade it on 3 real stocks. Let us build it step by step. Before any real chart, here is the whole plan on one simple diagram. 5 steps, always in this order. So, why does a sweep even work? Think about who is on the other side. Just above a price ceiling that keeps getting tested sits a pile of stop-loss orders, left by traders who bought, and by short sellers protecting themselves. The big institutions know those orders are sitting right there. So they shove price up for just a moment to trigger that whole pile. That is the spike. All those orders get filled. The big player quietly takes the opposite side, and price snaps right back down. That snap back, the close back inside, is your tell. Seen this way, a sweep is not random. It is a trap being sprung, and we are going to spring it alongside them. Okay, here are the 5 steps. Step 1. Locate the setup. A sweep needs 3 things: a resistance level that price has touched more than once, a spike that pokes just above that level to trigger the stop-loss orders resting there, and then a candle that closes back inside the level. That closes the signal. All 3, in that order. Step 2. Enter. You go short on the candle that closes back inside. Not on the spike. You wait for the close. The green line is your entry. Step 3. The stop. It sits just above the sweep high, with a small buffer of half the average true range. If price climbs back above that line, the sweep failed and you are out. That is the red line at the top. Step 4. Size your position. You risk only 1% of your account on the trade. The distance from your entry to your stop decides how many shares you can buy. We will do the simple math on a real trade. Step 5. Your exits. You take profit in pieces: a first target, a second target, and then you trail a final runner down to the volume point of control. The price where the most shares traded, which acts like a magnet. Those 3 green lines are your targets. That is the entire plan. Now let us run it step by step on a real Microsoft trade. Alright, let us trade one together, slowly, one step at a time. This is Microsoft in March. Watch how we build the whole trade, piece by piece. First, we find our level. Through late February, Microsoft kept getting pushed back down near 411. So right here, I am drawing a line at that price, 411.61. That is our resistance. Now watch this one red candle. Earlier in the day, price pushed up all the way to 413, poking above our resistance. But look how the day ended. It got rejected and closed back down here at 408.96, below the level. A spike above, then a close below. That is a liquidity sweep, so we take the trade. We go short, we sell. Right at that closing price, 408.96. There is our entry. Next, our safety exit if we are wrong. It goes just above that spike high. But how far above? We use an indicator called the average true range. When you add it to your chart, it draws this little line you can see here. And right now it reads about $9. That is how much Microsoft moves in a typical day. We take half of that, about $4.50, and add it to the spike high. 413 plus, that gives us 417.61. That is our stop. If price climbs back up to it, we were wrong and we are out. Now look at this red box between our entry and our stop. That is our risk, $8.65 for every share. That is the most we can lose on one share. So how many shares do we buy? Let us say your account has $10,000. The golden rule: never risk more than 1% on a single trade. 1% of 10,000 is $100. Each share risks $8.65. So we divide 100 divided by 865 is 11.5. We always round down, so we buy 11 shares. If we are wrong, we lose about $95. A bad day, not a disaster. Now, where do we take our profit? We use one more tool, the volume profile. These bars on the right show how many shares traded at each price. Now find the longest bar, right here. More shares changed hands at this one price than anywhere else, and we call it the point of control. Here is why it matters. The market keeps getting pulled back to it like a magnet. For Microsoft, it sits right around 400. That is our first target. We sell 1/3 of our shares there. Our second target is the prior low at 381. We sell another third. That leaves a final third, our runner. We let it ride the trend down, trailing our stop behind it, all the way to 356 before we are out. So a third, and a runner. And there it is, the whole trade on one screen. The sweep, our entry, our stop, our risk, 2 targets and a runner. That is one complete liquidity sweep trade from start to finish. Let us run the exact same 5 steps on a second stock, Google, a little faster now that you know the moves. Step 1, the level. Google had been turning lower, getting rejected near 311. Then, on March 18th, price spiked above it, up to 312, and closed the day back down at 307.69. a spike above, a close below, our sweep. Step 2, we short that close, 307.69. There is our entry. Step 3, the stop. Same method as before. The average true range reads about $7, so we take half and place the stop just above the spike at 315.95. The red box is our risk, $8.26 a share. Step 4, size it. 1% of our $10,000 account is $100. 100 divided by 826 is 12.1, so we buy 12 shares. Step 5, the targets. This time the volume is not stacked at one price, so we let our risk be the ruler. Our first target is one risk unit of profit below our entry. That is 299. Take a third there. Our second is 2 risk units down at 291. Take another third, and the runner trails the trend down to the prior low at 272. And there is the whole trade again. Same 5 steps, same picture, another clean winner. The plan never changes, only the stock does. Now the trade that fails. Because the most important skill in trading is knowing when not to take a trade. Apple, May 7th. And watch. By our first 3 steps, this looks like a textbook sweep. Resistance up at 288, a spike above it to 292. Grabbing the stops, a close back below at 287.44. That is our signal, so we build the trade exactly like before. Short at 287, stop just above the spike at 295. There is our risk box, and a beginner would set targets below and wait for the drop, the green reward box. Everything looks identical to our 2 winners. But here is the one filter that would have saved us. Look at the blue line, the 50-day moving average. It is the average closing price over the last 50 days, and it tells you the trend. On May 7th, Apple's price was sitting far above that line, and the line was rising. The trend was clearly up. A sweep is a bet on a reversal. But betting against a strong uptrend usually fails. You are swimming against the current, and that is exactly what happened. Apple did not drop. It pushed higher, ran straight up through our stop, and kept going, all the way to 315. The short was a loser. So here is the rule, write it down. Only take a short sweep when price is below a falling 50-day average. Only take a long sweep when price is above a rising one. Trade with the trend, never against it. That one check turns this loss into a trade you simply skip. Let us lock the whole plan into one checklist you can screenshot. 6 lines. 1. Locate a multi-touch level, a spike through it, and a close back inside. 2. Enter short that close, never the spike. 3. Stop just above the sweep high, plus half the 14-day average true range. 4. Size 1% of your account divided by your risk per share, rounded down. 5. Exit, take profit at your target and the volume point of control, then trail the runner with the trend. And the filter that protects all 5, only short when price is below a falling 50-day moving average, and only buy when it is above a rising one. Trade with the trend. Run this checklist on every sweep you see, and you are trading a complete, repeatable plan, not a guess. If this helped, subscribe for the rest of the series. And that is the complete liquidity sweep trade plan. The same 5 steps on every trade, every level staying on your chart so you always see the whole picture, and one filter that keeps you out of the losers. Here is your homework. Open any chart and find a level that price has tested more than once, then wait for a sweep, a spike through that level, and a close back inside. Mark your entry, your stop, and your targets exactly like we did today. Paper trade a few of them before you ever risk real money. If this made the plan clear, subscribe. We break down a new setup start to finish every single week. See you in the next one.